Welcome to the Deep Dive. We're all about cracking open compelling sources to bring you insights you can actually use. Today, we're stepping back to 2005. Now, that was a year that really put resilience to the test. Just imagine. Nature throws its worst with like a record-breaking hurricane season, and financial markets are doing their own unpredictable dance. It was a time that, well, it demanded some serious leadership and a really clear vision. So we're taking a close look, a really unvarnished look at the Markel Group's 2005 shareholder letter. And believe me, this isn't some dry financial report. No, it's candid, often pretty surprising, and frankly, a fascinating window into how a company stares down unprecedented challenges. It's a real testament to transparency, accountability in business.
Exactly. And our mission here in this deep dive is to unpack just how Markel handled those huge hurricane losses, but also, importantly, how they stuck to their long-term investment vision, through all that volatility, and how they communicated with just remarkable honesty. For you, the listener, what we hope you get are some invaluable insights into strategic adaptation, the sheer power of a disciplined investment philosophy, and what resilience truly looks like when the unexpected wallops you.
Okay, yeah. Let's unpack this. So 2005, let's paint the picture.
Huh.
Record-breaking year for hurricanes in the U.S. I mean, that's got to be a massive stress test for any insurer. For a company like Markel, deeply embedded in insurance, what did that actually mean on the ground? What was the immediate hit?
Well, the numbers themselves are pretty stark. Markel reported $246 million in hurricane losses for 2005. That's a massive number. And it ultimately tipped them into an underwriting loss of $12 million for the whole year. But here's the kicker, and they make this point very clearly in the letter. Without those hurricanes, their underwriting was actually, quote, remarkably strong. We're talking $234 million in profit otherwise. To give you a sense of that impact, look at the combined ratio. That's basically, claims and expenses paid out for every premium dollar taken in. It jumped to 101% from 96% the year before. So losing money on underwriting. And the hurricanes alone were responsible for about 12 points of that jump. And zooming out, the whole industry, 2005 was, and I quote, far and away the biggest and most costly on record. Katrina, Rita, Wilma, together they cost the industry something like $51 billion. Katrina alone is about $38 billion. Just huge number.
Wow. That is an incredible concentration of catastrophes, isn't it? The letter actually points out something amazing. 7 of the 10 most costly hurricanes in U.S. history happened in just those 2 years, 2004 and 2005. And Katrina, Rita, Wilma from '05 were ranked 1st, 7th, and 3rd. Did anyone, see that kind of cluster coming?
Not really, no. And that's where Markel's approach to handling the losses, estimating them, and being transparent about it becomes really interesting. They shared this detail. Their first estimates for Katrina and Rita were actually $254 million. But as claims developed, they found that was, quote, too conservative. So they reduced those estimates by $73 million, down to $181 million. But then, almost immediately, that bit of good news was offset because Hurricane Wilma hit, costing them an estimated $65 million. But through it all, they stressed their policy, set loss reserves prudently, and crucially, avoid excusing or implying the events didn't really happen. It's just a very clear signal of accountability, no sugarcoating.
Yeah, that transparency is really something. But, okay, acknowledging the hit is one thing. How did they actually adapt? I mean, Markel's business is assessing risk. How do you strategically shift when the very nature of that risk seems to be changing so dramatically, especially when these catastrophic events are supposedly, quote, a normal part of life,
Yeah.
but then take such an extreme turn?
Right. Well, they laid out 2 core principles for managing their catastrophe business. It's pretty straightforward. First, you've got to earn enough profits in the good years to more than offset the bad ones. Makes sense. Second, you have to manage your aggregate exposures. So make sure no single product line or the company as a whole is unreasonably exposed. And in direct response to '04 and '05, they took some concrete steps. They raised prices. They started relying less on the standard industry catastrophe models. They explicitly began planning for higher frequency and severity of catastrophes in the future. And they even said they were willing to withdraw from markets if they couldn't hit their profitability targets under these new assumptions. That's real discipline talking.
It's such an interesting paradox, though, that the letter points out. Markel has, over 90 different specialty products. Normally, that's a huge source of stability, right? Diversification. But then one massive event, like a hurricane, can hit multiple lines at once. It's not just property risk, it's
Exactly. It's drilling platforms in the Gulf of Mexico. It's even things you wouldn't expect, like motorcycle losses, maybe from flooding or damaged dealerships, stuff like that. It creates this really complex correlated risk. And a huge part of their adaptation was dealing with the fact that the industry models just weren't cutting it. The letter says these models significantly underestimated the magnitude of damage and also the unusual frequency of the recent storms. So Markel's response: augment those models. Use their own tools, build in a greater margin for safety. Which is a powerful lesson, isn't it? Models are tools, but when stuff gets really unprecedented, you need human judgment. You need that conservative buffer.
Yeah, absolutely. The letter also touches on these two kind of contrasting views on hurricane activity,
Yeah.
which I found really interesting. So on the one hand, yeah, 2004, 2005 definitely made it look like things were getting worse, more active, more severe. But then they say, well, if you look longer term, 10, 20, even 50 years, it's actually much more difficult to conclude that hurricane activity is increasing. Talk about confusing signals.
Right. It highlights this ongoing debate, but what isn't really debatable, and the letter points this out, is the impact of building and economic development in geographic areas exposed to hurricanes. That trend just keeps driving up the potential economic losses regardless of storm frequency debates. Though the flip side for the industry is more valuable property also means a bigger premium base to, cover those future losses. It's this constant dance, isn't it? Global events, climate science, models, risk management, market adaptation, all intertwined.
Okay, so this whole complex risk management picture reveals another layer of Markel's strength, right? The parts of the business not hit by the hurricanes. Because despite those huge headline losses, the letter is very clear. The vast majority of our product lines have little or no catastrophic exposures, end quote. And there was, quote, an abundant amount of good news in our operating units. So what were some of those bright spots keeping things going?
Oh, absolutely. This really shows the power of their diversification. Take their Shand Evanston unit, that's their excess and surplus lines business, handling, unique, harder to place risks. It had an exceptional year, achieved over 30 points of underwriting profit, which is fantastic. And the letter credits their disciplined underwriters who know when and where to walk away from business. They even gave an example: their physicians product line. Writings dropped from nearly $97 million in '03 down to about $67 million in '05 because competition drove prices too low for them. They walked away. Discipline. They also mentioned Shand's superior technology, their paperless environment helping efficiency. Then you had Markel International over in the London market. Their retail division consistently hit underwriting combined ratios in the low 80s. Really impressive performance.
That discipline really shines through. It shows how having that broad portfolio combined with strict underwriting creates these vital pockets of strength. Especially when other parts of the ship are taking on water, it really speaks to having those many different specialty products, over 90, like multiple engines running strong.
Totally. And even in the units that did take hurricane hits, there was still good news highlighted. Like Essex Insurance Company's contract casualty department, stellar results for 25 years running, the letter says. Markel Southwest underwriters actually exceeded profit goals despite the storms, and Markel American's motorcycle business increased margins, growing volume. Plus, they were already looking ahead, announcing a new unit opening soon, Markel Global Marine and Energy. So yeah, it's a story of finding success pockets even amidst the big storm, thanks to diversification and really focused execution.
Right. Okay, let's switch gears a bit. Let's talk investments. 2005 saw, quote, modest investment returns for Markel. Equities were sluggish. Interest rates were rising. How did that year's performance square with their very famous long-term patient investment philosophy, especially given those tricky market conditions?
Good question. On the fixed income side, the bonds, they reported a 3.9% return. Not stellar, but solid. They emphasized their focus on very high credit quality and, importantly, a shorter than normal duration, which basically means they structured their bond portfolio to be less sensitive to rising interest rates. It was a deliberate move to minimize the impact of higher interest rates. Why? Because they were wary of existing and future inflation risks. Now, equities, that was flat, negative 0.3% for the year, definitely below our normal expectation of double-digit returns, as they put it. But, and this is classic Markel, they immediately point out that our longer-term 5- and 10-year records still reflect excellent returns. Always that long view. And it all ties back to their equity philosophy. They have this 4-part thought process, right? They look for 1, profitable businesses with good returns on capital. 2, management teams with equal measures of talent and integrity. Crucial. 3, reinvestment opportunities and capital discipline, and 4, reasonable prices. What gives them a real edge is that long-term orientation. They plan to hold things for decades. That allows for, as they say, tremendous tax and economic efficiency. They mention having $438 million in unrealized gains at the time, with a deferred tax liability of only $153 million. That means all that pre-tax money keeps compounding for them. Plus, it cuts down on management fees, trading costs, even the cost of making mistakes.
That disciplined approach is clear, but, 2005 was a boom year for things like energy and gold. Was there maybe a temptation or even a risk in just completely sidestepping those hot areas? The letter says they did exactly that. Why?
Yeah, they were very explicit about minimizing energy and gold. And their reasoning is really insightful for long-term investors. For energy, they said, well, energy and energy sources change over time, which makes it inherently dangerous for long-term investors betting on specific sources. Think whale oil, right? And for both energy and gold, they felt that perception and geopolitical events swamp all other factors, not the kind of fundamentals they like to rely on, their preference. Long-term, durable, compounding businesses, predictable earnings, solid management. And similarly, they stayed wary of technology stocks, called them volatile and only minimally predictable. Again, doesn't fit their long-term compounding mold. It really is about knowing what not to own, isn't it? As much as what you do own.
Definitely. What about alternative investments? Things like hedge funds, private equity. They were getting pretty popular around then. Did Markel jump on that bandwagon?
Nope, they showed a healthy dose of skepticism there too. They actually quoted Warren Buffett's observation about markets moving from innovators, then imitators, then swarming incompetents. They believed the high fees often charged in alternatives would diminish the long-term returns for the actual investors, the owners. They basically said, we're happy to wait and watch. Quote, looking forward to participating in these markets as opportunities present themselves, presumably when prices fall after the swarm moves on. Interestingly, though, they did do 2 direct private deals in 2005, a majority stake in AMF Bakery Systems and a big minority chunk of First Market Bank. Why? Because those deals met their 4 criteria, and doing them directly, principal to principal, offered significant cost and return advantages. They cut out the middleman and those high fees.
Yeah, that whole section is just a masterclass in patient, disciplined investing, sticking to your knitting, prioritizing real value over hype. That conviction really comes through. Okay, so moving beyond the numbers, the strategies, what does this letter tell us about Markel's corporate culture, especially accountability, after a year that didn't meet expectations?
Ugh. This is maybe one of the most powerful parts, I think. It really shows their culture in action. The letter talks about their unique incentive compensation structure. It's tied directly to either underwriting profit or growth and book value per share. And they noted that over the past 3 years, our incentive compensation payments have averaged over 40% of base salaries. So it's meaningful money. But here's the kicker for 2005. Because the company didn't hit its book value growth goals, the letter states that over 30 associates will earn larger cash bonuses than the 6 members of the executive team. Think about that. The top executives took a direct hit in their bonuses because their specific target wasn't met, even while others whose units performed well got paid. That is real, tangible accountability right from the top. It's not just words in a report, it's how they operate.
Wow, that is powerful. Talk about walking the talk. But was Markel just doing its own thing in a vacuum? What was the broader insurance market like in 2005? Were those trends influencing them?
Oh, definitely not in a vacuum. The letter describes the general underwriting conditions as deteriorated. The market was increasingly competitive, and Markel's response, tied to that culture, was a disciplined focus on the bottom line, not the top line, which meant, again, they were willing to walk away from business that we believe is underpriced, even if that led to flat revenues for the year, profit over volume. They were also pretty skeptical about industry chatter predicting broad rate increases after the hurricanes. They basically pointed out that many competitors were probably selling insurance last year at a 50% or 67% discount, essentially underpricing risk, and we're now just trying to get back to adequate levels.
Okay, so pulling it all together, what's the big picture contrast here between Markel's way and maybe how others in the industry were operating then?
It really paints a stark contrast. The letter emphasizes Markel's focus on being long-term owners. And they contrast that with a lot of the new capital pouring into the reinsurance market, particularly coming from hedge funds, which often have a much short-term orientation. Markel expresses concern about these short-term players being willing to expose a large part of their capital to losses in the hope of quick returns, a model they believe does not work in the long run. Markel's strength, they argue, comes from its deep-rooted corporate culture of discipline, accountability, and integrity built over its then 75-year history. For you, the listener, this section really gets to the heart of how much corporate culture and how you align incentives, how much that impacts long-term success, and just, well, ethical business. It's a huge differentiator.
So yeah, 2005, clearly a year that, as they said, fell short of our expectations, only 3% growth in book value per share. But looking back at this incredibly candid letter, what are the main takeaways? What should we really remember from this?
I think the core lessons are just crystal clear, and they're timeless, really. First, the absolute critical importance of long-term thinking, not just in your investments, but just as crucially in your underwriting. Second, the power of disciplined underwriting, knowing your price, knowing when to walk away, even if it means sacrificing growth. Third, the value of patient, value-driven investing. Avoiding the fads, the bubbles, sticking to what you understand. And maybe underpinning it all, the immense value of a corporate culture that doesn't just talk about accountability, but actually lives it, embeds it in how people are compensated, how decisions are made.
Yeah, and even with that modest 3% growth number for the year, the letter just radiates confidence, doesn't it? They point straight to their 10-year and 20-year results of 60% and 28% respectively. Much better context. And they state, quite boldly, that they believe they will be a better company as a result of the experience of those tough years, 2004 and 2005. That's resilience talking.
It really is. And, this letter, reading between the lines, it asks a really profound question, I think. In a world that's often obsessed with short-term results, where capital seems readily available for almost anything, what actually defines a sustainable business? And maybe more importantly, how do you truly measure its success when the storms, literal ones like hurricanes or metaphorical market storms, inevitably hit and test everything you've built?
That's a great question to leave folks with. We invite you, listening, to think about how these principles, discipline, patience, that unwavering accountability, might apply in your own world, maybe in your finances, your career, or really any area where you're trying to build something for the long haul. Thanks for joining us on this deep dive.